So I'm Urooj Khan. I'm in the accounting division. I see a lot of familiar faces, people in my current class and my previous classes. So thank you for coming to attend this talk. And the research that I'm going to present is from a paper that's titled Earnings Quality on the Street. It's co-authored with a current PhD student at Columbia, Venkat Petireddy, and another accounting faculty, Shivaram Rajgopal. So I thought I'd use this paper because it sort of fits well with the, what the motivation behind PFS is, to sort of bridge practice with what we do in academic research. I'm an accounting professor, and many of you have heard me say this, but Warren Buffett, who's an alum of our school, describes accounting as the language of business. So that's how firms communicate with their stakeholders. And one of the most important products of the accounting system are earnings. It's a very important summary measure of a company's financial performance. There's a lot of focus on earnings from different practitioners, investors, and in the academic community, we have spent a lot of time trying to understand whether the reported earnings are of what we call good quality or bad quality. So what I mean by good or bad quality is two companies with similar businesses, similar asset bases, reporting the same earnings number need not be earnings which are of the similar quality. What I mean by quality is the accounting information or earnings doing a good job in presenting the picture of the underlying fundamentals of the business. So earnings which will not be of good quality will be earnings where a firm might have used some accounting or financial reporting choices to mask what the underlying fundamentals or the underlying economics of the business might be. It's a hot topic in practice, in the investor community, and as academics, we spent a lot of time trying to understand this. But here's the interesting part. The way I teach you or the way you learn to assess accounting quality or earnings quality is sort of similar to what's done in practice. Typically, if you think of investors who are one set of practitioners, the way they would assess earnings quality is they do bottoms-up fundamental analysis. So they will do granular industry-specific analysis of a company. They'll get information from their financial statements, obviously, from the footnotes, from other public sources. They use information of their competitors. All this to sort of build a picture about what the underlying fundamentals of the business are. And are the reported earnings or are the reported accounting disclosures doing a fair job in describing the state of those fundamentals? Very similar to what, when you're in my class and I talk about financial statement analysis, I tell you that this is what we should be doing. In academic research, hasn't spent a lot of time systematically analyzing how earnings quality is operationalized in the field. What academic research has largely done is they have developed these large sample models through which they sort of model the quality of a company's accruals. There's some other models, but I'm just going to pick on abnormal accruals over here. And they sort of estimate these. These are relatively easy to estimate from the machine-readable data that's available in different databases. And this is an example of a very early earnings quality model that's used in academic research. So without getting into deep details, basically what this is telling you is that current accruals in the current period are a function of a company's change in sales and lagged current accruals. You can ignore this other term. Those are just dummies for different quarters because this is a quarterly version of a model. And these have become extremely popular in academic research and to a large extent, to some extent in quantitative investing too. If you go to practice, firms that have quant models of investing, if they're using some accounting-based strategy, they might be using models very similar to these. But there is a problem with these models. There's a reason why they became so popular. They're easy to estimate. Most of the times in academic research, We are not doing case studies with individual companies. Our focus is large sample analysis. And even in quant investing, people are not looking at typically individual companies. They're coming up with strategies that help them invest across a broad set of companies. The problem with these models is, just a very quick summary. If you estimate these models trying to identify which companies have poor earnings or they're using aggressive reporting tactics, the residuals, which is the measure of the accounting quality or earnings quality, it appears that they're just too large to represent actual earnings management that's going on. At the same time, it appears that every firm in every quarter is managing earnings. And even if you believe that these models are giving you great insights, you are left with the mystery that what exactly, which account or which item is the company managing. These models don't tell you that, because all they tell you is that this is the residual and these companies might be managing earnings. What fundamental analysis, the way it's done in practice, is different, where they're looking at signals related to particular accounting choices, and through that, they are identifying which companies might be managing earnings. So what we do in this practice is we're sort of trying to bridge this gap. We are trying to, first of all, provide evidence. It's been a while since academic papers have looked at this, to provide some systematic evidence at how exactly is earnings quality operationalized in practice. And by practice, we have a rather narrow view. We mean by investors. So, how are investors doing fundamental analysis? At the same time, once we sort of go deep into it, we see, can we get some insights from this? And can we, let's say, improve the academic modeling of earnings quality as well? So those are two objectives. And what we do is, we were lucky to get in touch with a research firm. It's a large research firm. I can't reveal their name, but they are doing fundamental analysis. They're one of the largest. And we get their research reports, a data set of all their research reports. So this is a large research firm. It monitors more than 9,000 publicly listed firms. And their business model is to basically do bottoms-up fundamental analysis of these companies. And their clients include institutional investors to whom they are basically providing signals to potentially highlight firms which might be using aggressive financial reporting choices to present a picture that's more favorable than what the underlying fundamentals or the underlying economics might convey. So essentially, they're identifying firms which might be using accounting discretion or some other choices to basically pretend that they're doing better than what the actual underlying performance is. So that's the business of this firm, and they provide reports to their clients who subscribe to them. So we got 1,000 reports from them, which cover basically 348 unique firms for the period between 2004 to 2015. And then we dig into them and we study them very carefully. Something to keep in mind, that these reports are based purely on publicly available information. We confirm with them, because otherwise a comparison between the existing models of earnings quality and these reports is not fair, because the existing models of earnings quality use publicly available information. So we confirm with them that they do not have access to private information through management. They are only using publicly available information. And they are basically providing, as I said, signals to the institutional investors who are largely looking to short these companies or cut back their long positions. So that's what their objective is. We find that out of these 348 firms, on average, a firm is covered 3 times. And they continue to cover firms if they find that there's some sort of accounting manipulation that's going on and the firm is overvalued. But if the overpricing has not disappeared, if the race concern has not been fixed, or some new concern appears. So they continue covering these firms. So now that I've given you an overview of who they cover and why they're writing these reports, I'm going to give you some data about what the kind of companies they actually cover. So it's not surprising. This is a distribution of the firms that they cover based on their size, that their focus is relatively larger firms. So now remember, the incentive or the business model, that their business model is to provide signals to take potentially short positions for their investors. So you need large firms which have relatively low barriers to arbitrage, so their coverage is sort of focused on these large firms. So you can see much of the action is going on in the higher size deciles. At the same time, it's a pretty broad-based general fundamental analysis firm. They're not focusing on any one specific industry. We've removed the financial firms from our sample because they're a completely different animal. But with respect to the non-financial firms, their coverage sort of imitates the coverage of the general population of firms. Computers and durable manufacturers are slightly overweighted. So it's a pretty generic, general fundamental analysis firm that they're doing. So what we do is we actually read all those reports and we identify what are the different metrics that they're using as red flags in these reports. So we are able to identify 121 different metrics and we classify them in different categories, which basically highlight like, a metric. This is basically reflecting concerns about potential sales quality, the margin, are they using some choices or some techniques to pretend that the margin is better than what actually is, highlight concerns about their cash flows, and then there's a category where, everything else other than sales, margin, and cash flow. So this is what it looks like. I won't disclose to you all the 121 metrics because again, we are sort of can't do that because of our confidentiality agreement, but I'll show you what are the typical concerns. So not surprising, the biggest concern or the biggest red flags relate to revenue. Firms are using choices to inflate the quality of their sales or basically report revenues that appear to be more sustainable or better quality. So the kind of things that the firm is doing is they're looking at, is the firm selling to the marginal customer in terms by looking at the quality of account receivables. It is doing detailed analysis about the credit quality of their customers. Is it looking like, okay, is the firm borrowing from the future by recognizing some of the revenue in this period from the deferred revenues? So all that stuff is going on within sales quality, which is the number one category in terms of the red flags. Then comes margin quality. Firms, on average, they're about 42% of the firms which are making certain accounting choices to make it seem that their margins are relatively higher when they might not be, or these margins might not be sustainable in the future. So typically, the kind of things that firms are doing is they're actually not creating enough provisions for bad debts, for inventory obsolescence, or warranty, or they might be reversing some of these margins. In cash flow quality, they're looking at our firms classifying, recognizing non-recurring cash flows. Are they classifying some non-operating cash flows as operating cash flows? And then there's the others. There are a bunch of other techniques that firms are using to sort of present a picture that's more favorable than what the reality might be. So we sort of go these, we collect these metrics, we provide some descriptive evidence, and the next step that we take is we sort of now start validating these reports. I mean, is it the case that, of course, these institutional investors are paying big money for these reports, but is the information content in these reports any different from what the other academic models of earnings quality is? Or they're just doing the same thing and they're repackaging it as a very different product. So to do that, what we do is we calculate what we call abnormal accruals, one proxy of poor earnings quality or earnings quality, and we rank all the firms which have been highlighted by this research firm as potentially bad. And these are based on signed abnormal accruals. So what you would expect is that if those accrual models are doing a good job at capturing earnings quality, where higher, more positive abnormal accruals reflect choices to report manage earnings upward or manage earnings higher, you should expect that most of these RF identified firms fall into quintile 4 and 5, because these are the more positive abnormal accruals. What we find is, well, yeah, they are slightly overweighted in quintile 4 and 5, but we do see that they also fall in the lower quintiles. If those models are actually doing a good job at capturing earnings quality, we should not really find many of these RF firms in these lower quartiles, because these are negative or low positive abnormal accruals. So, what we sort of take away from this is, well, it seems that these models, the academic models, are not doing a very good job at sort of capturing granular, context-specific, industry-specific fundamental analysis. So that's the takeaway from here. Now, to assess the credibility of this signal that the RF is providing to its clients, we see, like, are there any abnormal returns around the issuance of this report? I mean, if there's some new incremental useful information and the clients take actions on that, you should see some incremental returns around the release of these reports. So we calculate the abnormal returns around the 2-day window when these reports are initially issued to their clients, and we find that, yes, there is a significant negative 1.3% return. And if you expand the window to a year, that return is negative 18.5%. So this is the abnormal return. Again, there might be an overlap in the information in the RF signals and the existing state-of-the-art models of earnings quality. We try to assess that, okay, is there some incremental information in the signal beyond what we already know from other earnings quality signals? So we sort of run this regression where we are running, regressing 1 year ahead abnormal returns on all the state-of-the-art earnings quality metrics that we have right now. And we find that the intercept is negative and significant, suggesting that this signal has incremental information beyond the existing signals of earnings quality. So at this stage, we take a break and we say, you know what, we've sort of established that these signals are actually credible, and we can actually use the insights that this research firm is providing us might be meaningful. So the second part of our research, what we do is we say, okay, what can we do with these signals? Is there a way where we can use this fundamental analysis to build a systematic methodology where we can sort of build a quantitative earnings quality score? So to do that, we focus on 3 industries. These are 3 industries which cover about 50% of their sample, about 40% of the population of general firms. And these are retail, durable manufacturing, and business services. So we focus on these 3. And we go out and see what are the metrics that the research firm is using when it is analyzing these firms. So this is a list of 20 metrics. And the way this research firm operationalizes its analysis is it's doing it on an industry by industry basis. And in their comparison, they look at the reporting firm to its peers and how those signals have evolved over time. So there's time series comparison and there's a cross-sectional comparison, and it's confined to one industry. So we take 20 signals for which we can get machine readable data. Some of them are industry specific, like unbilled receivables to sales, which is more common in durable manufacturing and business services. Same-store sales growth is a lot more common in retail. But you can see they don't simply use same-store sales growth. They combine it with the change in gross margin. And the idea here is that if you simply use same-store sales growth, an increase in that might be a good signal. Yes, the sales is increasing, but is it coming at the cost of decreasing margin? So that's where the context-specific thing comes into being. So they sort of combine the same-store sales growth along with the change in gross margin. So we take these 20 signals and then we try to build a quantitative score using these 20 signals. So the way we do this is to, again, implement the approach used by the RF firm into sort of a systematic methodology. We take those 20 signals and we compute the annual change in each signal and also the volatility of each signal to see, okay, how these signals have evolved over time. In step 2, we try to identify whether any of these changes are extreme in the cross-section. So we give any of these changes a signal for an extreme value if they are above the 80th percentile in the cross-section within the peer firm. So we rank them by industry and calendar quarter, and we give them a signal for being an extreme value. But just because the change is extreme does not necessarily mean that the firm is using it to mask its underlying fundamentals or show its position better than it actually is. To sort of get at that point, we see its association, the association of the extreme change with the likelihood that fraud is being conducted in that particular quarter. So, you could argue that one of the most extreme forms of managing earnings is committing accounting fraud. So we use something called AERs, and we compute the association between these signals, these extreme changes, and the fact that that quarter might be fraudulent. We do this using data over the prior 5 years, and we get the weights for each signal. And finally, we take those weights and we apply them to we calculate what we call the RF score, which is the sum of the weighted sum of all the 40 extreme value indicators scaled by the sum of the weights. And basically, we get the score where higher values of the score represent poorer earnings quality. Basically, it means that if the score is higher, it might be the case that the firm is using financial reporting choices to basically mask its underlying fundamentals. We do this for 2006 to 2012, and then we sort of validate the score and see whether it actually measures poor earnings quality. So the first thing is we sort of do out of sample analysis to identify, compared to other earnings quality indicators, is it doing a good job at identifying potential fraud? We compute type 1 and type 2 errors. Type 2 errors, which are arguably the more costly for regulators, auditors, and investors, it offered significant improvement compared to all the other earnings quality metrics. The type 1 errors are relatively similar, and in terms of the classification rate, it offers the best classification rate amongst all the different earnings quality indicators. So, it sort of gives credibility to our signal that yes, it's doing a good job at identifying poor earnings quality. The next thing we do is, well, if it is doing a good job at identifying poor earnings quality, is it predictive of future returns as well? So we run this regression where we basically compute the 1 year ahead returns from the end of a quarter, and we use the RF score from that quarter to see if it's predicting future returns. We compare it to all the other earnings quality indicators that are out there today, and we find that it has incremental information beyond that. It basically subsumes the information in most of the indicators. The only other one that's actually significant for the most part is the total accruals. All the other ones get subsumed by our score. And the score is based on industry-specific comparison using some signals which are a product of fundamental analysis. So to summarize what we are doing, our objective is to sort of push the academics in the area that, yes, these large sample models are great, but there is still value to granular fundamental analysis. And our message to the industry, to investors is, a lot of the funds, a lot of investors have sort of moved into quant investing where they're using accruals as a signal. You can still use signals from fundamental analysis and you can develop them into a quantitative score which are predictive of future returns. So it's a dying art, but it's still valuable. And if you're more interested, the paper is available at this particular website. Okay? Thank you so much. Yes.
Can you talk a little bit more about your data set? What was it, like the 300 and change companies that you chose?
So our data set is basically every single report that this research firm wrote for their clients, and they gave us a complete dump of those reports. And we identify, we get about 1,700 reports, but after you get rid of multiple reports and all that stuff, we end up with about 1,000 reports. These relate to 348 unique firms, and they're written on a quarterly basis. They typically come out 35 days after a firm reports its earnings, because they're a fundamental, they're a bottoms-up fundamental analysis firm. So they focus on these firms' earnings announcement, filing their financial statements, and then they sort of analyze them. And they're written pretty uniformly across all the quarters. And they're actually very insightful. They don't provide any recommendation in terms of valuation or what the target price should be. They just highlight accounting, financial reporting issues with these firms. And they have different concern levels. It just so happens that they don't write the report if the concern level is low. So the concern level that we observe is always 4 or 5 on a scale of 1 to 5. So it's a very interesting and rich database. I wish we could publish more details, but they don't want us to do that. I mean, that'll be sort of stealing their business model if we sort of do that. Yeah. Oh, sorry.
Can you talk a little bit more about how you want this to be absorbed in practice? Because I guess when I think of adjusting earnings, I think of that as a very
manual process in which you're kind of getting contextual clues as to where the management's happening. So
Yeah.
where does that marriage?
So, our objective is, this is written as an academic paper. So when you read the paper, we don't really make a big deal about what the practice should do. But the way what we don't want people to do is, what's happened with prior academic papers is, people take those models and they just simply estimate them without thinking the context in which they are developed. So the model that I put on the screen was written in 1991 for a very specific setting where certain firms in a certain industry were basically being, I think, evaluated for some import duties and all, and they had incentives to manage earnings. The way it evolved from that is people took that model and they started applying to all firms in all settings and all that. What we want practice to take away from this is to say that, rather than simply investing based on the level of accruals or abnormal accruals, look at individual industries and see what their value drivers are. Identify the value drivers of each industry and then build a quantitative score. You can still build a quantitative score using those fundamental drivers of a business. Don't just follow these accrual models to guide your investing. It's sort of happening there. Like I was reading an article today about D.E. Shaw in FT. And then what they call is quantamental. So that is combining quantitative investing with fundamental analysis. It's sort of moving there, but if you look at value investing, this is similar to value investing. But value investing is done on a firm by firm level. This is sort of the quantitative version of that investing. Yes, Jane.
You mentioned that the coefficient on total growth is two. What do you think is the reason?
It's a good question. I'm not sure. There's some incremental information there. It's probably the least noisy of all the measures. Abnormal accruals are more or less similar to what the total accruals are. But yeah, total accruals are still coming through. I'm not sure why that's the case here. Yep. Okay. Thank you so much.